Hey guys, we're back in the office. All right, in today's video, we're going to be talking about the Fidelity Information Technology ETF known as FTEC. All right, that's going to be FTEC. It's a very popular ETF. It's been getting a lot of traction recently, so I just wanted to cover it on this channel. So let's go ahead and get into it. So this is going to be the FTEC overview. And this is what we're going to be covering today. We're going to be talking about the ETF, the key metrics, the composition, as well as the risks. And at the very end, like always, I'm going to give you guys some tips for success. All right, so this is what the ETF is. It is the Fidelity MSCI Information Technology Index ETF, also known as FTEC. It invests in public equity markets of the United States and invests in stocks of companies operating across information technology sectors. All right. The investment composition, the fund invests in growth and value stocks of companies across diversified market caps. And the underlying index, for those who don't know, the fund seeks to track the performance of the MSCI USA IMI Information Technology 2550 Index. All right, I'll put a link down below to what this index actually is. All right, because a lot of people think that this tracks the NASDAQ 100 or that it's some rules based or some arbitrary, ETF. It is kind of important that you know how these ETFs are constructed. So similar to like how QQQ tracks the NASDAQ 100, this ETF tracks a different type of index provided by the MSCI company. All right. So this is the key metrics of this ETF, and this is very important. Okay. So this actually, let me get my red pen here, like always. So the inception date was October 2013. Okay, 2013 is when this ETF came out, and that's important because it has a 10-year performance track record. All right, you don't want to invest in ETFs that have track records under like 2 or 3 years. I wouldn't personally. Entirely up to you if you want to, but having this type of data just kind of shows how it's performed, especially during a very volatile time. I mean, if you look here, this is when the pandemic happened, and then, everything was gold. And then here is when the interest rates were really hiking up, right? This is when interest rates went high. And then as you can see, even though we're in like a interest rate, lowering environment, it is doing very well. So another part of this metric that we want to see is how much is the expense ratio. Okay, and this actually has a very low expense ratio, which is very important. So that means on every $1,000 invested, you're going to be paying 80 cents. So over the lifetime of this fund, if you were to constantly invest money into this and hold it for say 20, 30 years, you'll probably only be paying $10,000 over the lifetime of owning this fund. Now, compare that with something that might be, 0.50% in expense ratio. That could be like $150,000 worth of fees. All right. Whereas this one is only 10,000. So I would say this is a pretty low, actively managed type of ETF. Well, it's not actively managed because it's following the index. Duh. So, but I would say this is a very, cost effective ETF. It's very cheap. All right, so we all know that tech doesn't really pay out any dividends, so this ETF is a reflection of that. It doesn't pay out that much of a yield, which again is no big deal because again, this is a growth type of play. All right, this is going to be an ETF that you're going to hold for a very long time, and it's going to continue to grow because technology is all the rage, right? I'm not saying that. I don't have a crystal ball. I'm not saying that it's always going to go up. There will probably be a period of time where this thing goes down because the entire tech sector is down. Okay, so again, you just want to be mindful of these types of things. It has 13.5 billion dollars in assets under management. And this is important because this is telling me that there's a lot of investor money in this ETF, in this product. All right. So I wouldn't go with an ETF with, sub 100 million in assets under management because it just gets kind of risky. It means that like not a lot of investors are putting their money in there. So when you have something that starts reaching the billions of dollars, it's a sure, I won't say bet, but it's a sure sign that it's, an ETF that is doing very well, right? That a lot of people trust. Okay. So just, because it's fun to see dollar amounts. If you invested $500 starting in January 15, or January of 2015, and you held it all the way till November of 2024, it would be worth $209,000. All right. And that's over a span of 10 years. And that's only if you kept putting $500 every single month into the ETF. So that's pretty cool. That is a lot of money, especially in 10 years. You know, you can only imagine what the next 10 years would look like if you kept that up, if you kept putting $500 every single month. Okay. So just wanted to cover these points. So this is the composition makeup, all right, of FTEC. So as you guys can see, let me get my little, we'll go with blue today. So as you can see, it is mostly in technology, right? Mostly in technology, whereas QQQ and QQQM, you know, they have kind of, they're invested in more other types of sectors, you know, industrial, healthcare, consumer cyclical, information tech, of course, and financials and things like that, right? Whereas this one is primarily mostly in technology. So that comes with its own risks, which I'll cover here in just a second. But let's look at the top 10 holdings. So of course it's going to have NVIDIA, right? Because NVIDIA is all the rage right now. It has Microsoft, Broadcom, Salesforce, which I'm actually kind of surprised about, Oracle, Adobe, ServiceNow, Cisco Systems, and Accenture. All right. And it has a total makeup of 296 companies, right? So when you buy this one ETF, you're getting instant, immediate diversification amongst 296 different companies, right? That's pretty good. So your risk is lowered, right? But because it's so concentrated in technology, you know, that might elevate the risk a little bit more, because typically technology companies are a little more risky on the higher risk side of the spectrum. But it doesn't mean, you know, it doesn't mean it's bad, right? It doesn't mean it's bad. It means it's more volatile, all right? There will be ups and downs, large swings up and down, okay? That's what it basically means. Okay, so these are the risks with investing into FTEC. You have sector concentration risk, which I kind of already alluded to. FTEC invests mostly in tech companies. If tech companies start doing poorly, FTEC might lose value because it doesn't have investments in other types of businesses to balance things out, right? As you guys saw in the last screenshot, it's basically 98% in the technology sector. All right, there's market volatility risk. Since FTEC is all about tech, it can have large swings in value. Tech companies can quickly change, making this a higher risk, higher volatile investment. There's also the interest rate risk, which most companies are susceptible to, or even ETFs. If interest rates go up, people might spend less on tech, and tech companies might earn less money, right? No one's buying anything. No one's going out to, you know, the stores or ordering off Amazon, any new technology or things like that. So obviously the companies are going to feel that. And then even for software type of companies like Adobe or ServiceNow, you know, maybe companies are not renewing their contracts, or they're not buying the newer software packages because these companies are saving money. You know, it could be a whole domino effect of things, right? This can make FTEC's value go down as the companies are affected. So it's just, again, something you want to keep in the back of your mind. I'm not saying that this is a poor or a bad investment. I'm just trying to give you guys, you know, everything. Quick shout out for my community on Skool if you guys want to check that out. It's just a bunch of people coming together and, you know, learning how to invest. And, you know, I do a lot of posting in there. So if that's something you guys want to check out, please go check it out. All right, so here's some tips for success, guys. You want to diversify your investments. And I always talk about this. You always want to diversify. Don't put all your eggs in one basket or one sector. All right, you want to spread your investments across different types of assets like stocks, crypto, and real estate. This way, if one type of investment isn't doing well, the others might balance it out, reducing your overall risk. So if we're looking at our portfolio, again, you can go at this several different ways. You can have 50% in like an S&P 500 index fund, and then 50% in like FTEC. You can also do a 70-30 split, or you can do maybe like a 50% S&P 500 index with 20% FTEC. And then maybe you'll have like 20% in, I I don't know, something else, maybe like some stocks or something, like individual companies that you have like a high conviction on, and then maybe 10% in bonds. I don't know, like you can really play around with this, but again, you want to kind of just diversify. And when you invest into an S&P 500 index fund, I mean, you're spreading your risk across 500 different companies. So just the two ETFs, even though they'll have some of the same companies in their ETFs, you're gonna have between 500 and 700, almost 800 different companies. You'll have, you'll be able to spread your risk across. So again, really good, something to think about. Okay. You want to stay consistent. Keep investing a set amount on a schedule. This strategy is known as dollar cost averaging, and it can help you buy more shares when prices are low and fewer shares when prices are high, potentially lowering your overall cost per share over time. This is known as the cost basis. So again, when you're investing for the long term. Have a plan to invest regularly. Every time you get paid, set a set amount, whether that's 10%, 15%, 20%, whatever it is. Just have it set so that you already know once you get paid, that amount of money is going straight into your investments. Okay, that's very, very crucial. This is where a lot of people can't even do, right? This is what a lot of people can't do because, they have to pay off all this other stuff, which is, I guess everyone's, situation is different. But again, you just want to be consistent. All right. You always want to invest. Again, you're building wealth. You're investing for the long term. All right. And then you obviously want to be learning continuously. The world of investing is always subject to change, so it's important to keep learning. Stay updated with the financial news, read books, and consider taking courses on investing. The more you know, the better decisions you can make. I can't hit this home enough. All right. This is a piece of the total puzzle. Investing in FTEC, okay? Because depending on where you're at in life, you could be in your wealth, preservation stage of life where, you're trying to hold on to more capital. You don't want to really be investing in higher risk assets like FTEC or technology stocks. Or you might be in your wealth growth stage where you're trying to grow your money as fast as possible, right? And then you start getting into these thoughts. Should it be in a brokerage account? Should it be in a tax advantage account like a 401k or a Roth IRA? What kind of account should it be in? Do I plan to sell out of it, much later in life, use it as a bridge to retirement? Or should I just do XYZ with it, right? You have to keep learning. You have to keep asking questions, and you have to keep talking to people and keep watching educational content like this. All right. Because that's really what's going to make the difference for you later in life, right? It's going to give you more options. So always, always, always be learning. So other than that, guys, I have nothing else for you. I hope you guys got some value from this video. I hope you guys got tremendous value from this video. If you liked it, like it, please put comments down. I really want to get better at making these videos for you guys. If you guys have another ETF you want me to review, please put it down below. I'm excited to be helping you guys and making this type of content. So other than that, I'll see you guys in the next video.